Welcome to Talk Tickers. Today, we are diving deep into Sony's latest earnings call from November 11th. Now, the report itself had a lot of moving parts, but you know what? The market's reaction was loud and crystal clear.
And let's just start right there with the market's final verdict. A huge 4.25% jump in the stock, and get this, on more than double its average trading volume. That tells you investors didn't just like what they heard, they loved it. So let's unpack exactly why. All right, let's get into the headline numbers. What we saw from Sony was a classic beat and raise quarter. And if you follow the market, you know that's exactly what you want to see. It really set a positive tone right out of the gate. So as you can see here, revenue hit a record 3.1 trillion yen. That was a nice little beat over what Wall Street was expecting. But the real story, the bigger surprise, was on the bottom line. Earnings per share came in at 51.71 yen, smashing expectations by a solid 3 to 4%. But honestly, the headline beat doesn't even tell the whole story. The real magic was in profitability. Operating income hit an all-time record for a second quarter, jumping 10% from last year. So you gotta ask, right? Where did that unexpected strength actually come from? Well, that question brings us to the core narrative of the quarter. When you look under the hood, you see this massive split in performance across Sony's businesses. It really was a tale of two Sonys. And this chart right here, it tells you almost everything you need to know. Just look at how big those slices are for music and for image sensors. This is the big takeaway. Sony isn't just the PlayStation company anymore. Its new growth engines are absolutely firing on all cylinders. And here's where you really see that split personality in black and white. You had just incredible growth from music and image sensors. Their operating income shot up 28% and a whopping 50% respectively. That insane strength more than made up for the turbulence they saw in their flagship gaming division. And that music segment, wow, it was totally supercharged by Sony's strategy of focusing on its own intellectual property. The CFO, Lin Tao, pointed it out perfectly. The anime Demon Slayer just became this global monster at the box office, proving how incredibly valuable owning these worlds and characters really is. Okay, so what about that 13% drop in the high-profile gaming segment? What happened there? Well, it was mostly due to a technical thing called an impairment charge of almost 50 billion yen. Basically, they had to write down the value of their Bungie acquisition because the game Destiny 2 just wasn't performing as well as they'd hoped. So, with all of that going on, what did management say about the future? Well, this is where it gets really interesting. Because of that incredible performance in music and sensors, they felt confident enough to actually raise their forecast for the whole year. And they didn't just nudge it up a little bit, they hiked their full-year operating profit forecast by a massive 8%. For a company of this size, that is a huge signal of confidence in what's to come in the second half of their year. And just so we're all on the same page, a guidance hike like this is one of the most powerful, most bullish signals a company can send to investors. It's management basically stepping up and saying, hey, our business is doing even better than we thought it would. And this wasn't just wishful thinking. They raised the forecast for very real reasons. They saw a smaller hit from U.S. tariffs than they'd feared, and crucially, they expect the powerful momentum in their music and image sensor businesses to just keep on rolling. So now, let's connect all the dots. All of this brings us right back to that stock chart we started with. Now you can see exactly why the market reacted the way it did. The pieces of the puzzle just fit together perfectly. The stock gapped up at the open, which means it literally jumped higher the second the market opened, right after the pre-market announcement. And you can see it held on to most of those big gains all day long, closing up more than 4%. And here's the kicker. This move was backed by heavy volume, more than double the recent average. That's not just everyday investors getting excited. That is the big money, the institutions stepping in and saying, we believe this story, we're buying it. All right, so that's the story of the quarter. But what matters now is what's next. Where does the stock go from here? What's our call? Well, here's our take. We are initiating our official coverage on Sony with an outperform rating. Plain and simple, we believe the market is still underappreciating the incredible transformation that's happening inside this company. Our price target is $34, and the thesis is pretty straightforward. Sony is turning itself into an IP-driven entertainment powerhouse, and that's building a more reliable, more powerful money-making machine for the long term. We think the strength in music,
anime, and sensors is more than enough to carry them through any slowdown in the gaming console cycle.
So you're probably asking, okay, that's great, but how would you actually play this thesis? Well, here's an interesting, maybe a little out there idea that really captures the story of this quarter.
You could consider what's called a pair trade. You'd go long Sony's stock, betting it will go up, to capture all that upside from its diversified IP. But at the same time, you could short a pure-play gaming ETF to hedge against potential weakness in the overall console market. It's a direct bet on this quarter's core narrative, that Sony is now so much more than just a gaming company.
And of course, we have to say this, and it is super important. This is not financial advice. Please always be sure to do your own research before making any investment decisions.